China's consumer price index took a large tumble last month. Consumers paid 2.1% more for goods and services in March than they did a year ago, signalling tame inflation for the world's second largest economy. To discuss whether the news will allow the People's Bank of China to hold off tightening monetary policy and what problems remain for the economy, I'm joined down the line by Michal Meidan, Asia analyst at Eurasia Group. Michal, thank you for joining me. Now, what are the main reasons for the drop in CPI, and is it now contained?
I think essentially, first is that there's always a discrepancy between the February figures. February is traditionally the Lunar New Year, and figures are always somehow distorted throughout that month. So there's a natural drop. After February. There's been also a drop. The CPI figures are lower this month because of lackluster demand for meat, and that's on the back of the bird flu, the dead pigs floating in rivers. There's less of an appetite for meat, and that is also one of the things that fuels inflation. And also, part of the growth story in China, a big part of the growth story in China, has been government-driven stimulus, not so much the pickup in, or to a lesser extent, the pickup in incomes and in farming costs and prices. But I think moving forward, the battle against inflation isn't over. There's still a high potential for inflation to pick up as wages increase and they move forward with rural sector reform, and farm output generates more costly output that then trickles into inflation.
You touched on exports there, but how much does China feel the impact of the recent sluggish growth in the United States and the recession across much of Europe? How much does this affect export demand?
Surprisingly enough, it hasn't really affected export demand. The export figures have been very strong. The data coming out of China has been, with exports up almost 20% in the first 3 months of the year, sort of year on year, which has led quite a few people to speculate that there are discrepancies and problems with the figures. So that there has been a pretty strong rebound, and part of it is probably misreporting and problems with taking stock of actual activity. There is a pickup in growth, that's evident, but in the long term, and the Chinese economic goals are towards rebalancing. It's to become less reliant on exports. So the fact that their traditional export markets, such as the US and the EU, are presenting sluggish growth is just another incentive for them to move forward on their economic rebalancing agenda and to focus more concertedly on spurring domestic consumption growth from their own domestic sources.
Have the efforts the Chinese government have gone to take the heat out of the real estate market made a difference?
I think it has made a difference. There is a game of cat and mouse between government and investors, and the real estate sector is going to be the tricky and the riskiest sector probably in the Chinese economy. There are structural risks and structural problems within it. But anecdotal evidence and interviews that we conduct with people and developers on the ground show that quite a bit of the pickup in interest and the appetite for housing does come from first-time buyers and not just developers. That's obviously, in the tier one markets, the big Beijing, Shanghai, Guangdong. Much of it is speculative and is developers looking for investments because there are limited opportunities to invest in. But that's why we're also seeing a very differentiated approach to the first tier markets and the second and third tier markets. There's always this game of back and forth, but I do think that the government has the policy tools and does have that adaptability to try and deal with the property market. For now, there's always a risk that they step on the brakes too hard, too much, but then they'll just pull back gradually.
So lastly, do you see the gradual growth in China as sustainable?
I think for the coming year or two, the government's ability to sort of engineer growth and their willingness to do so is still high. Further down the line, in 2-3 years, it becomes much more difficult to sustain, not so much from an economic standpoint. There's a huge amount of potential in terms of manpower, resources, work that needs to be done, sort of economic activity that needs to be done in China, it becomes more politically unsustainable because the income gaps, the expectations for reform, all of those increase, and the pressure on the government increases accordingly. So if in 2-3 years they do not start to undertake more systemic reforms which tackle income disparities, which create more jobs for, young unemployed college graduates, and don't tackle some of the issues of representation within the Chinese system, that's where it gets a much more socially volatile system, and that risks going into slower growth rates and a Japanese-style lost decade. But in terms of the economic potential, they still have the ability to engineer this kind of growth for another 1 or 2 years, I think.
Thank you, Michal. Michal Meidan there from Eurasia Group. Join me tomorrow when I will be bringing you the day's top headline in the form of a Dukascopy press review. Take care.